Hi there, I'm Heather Gill, local realtor here with eXp Realty, and today I'm talking to Karen Burkholder. She is a Medicare specialist here in the state of Texas, and we had a question come in to texaselder.care. Karen, I thought you'd be a great person to talk to about this. The question we had today was, what is the difference between whole life, UL products, and term? Can you help us with that?
Thank you, Heather, for having me on today. Yes, I can help you with this. Life insurance. So you have the whole life insurance, and the way they taught, the only thing in the class to get to pass the test for insurance that actually applied was the explanation on the difference between these products.
Oh,
so
okay.
a whole life, so if you want $1 million policy,
Okay.
and you're starting it at age 20, so you subtract 100 from 20, so that's 80.
Okay.
So you've got 80 years to pay into the policy. So you want $1 million, you divide $1 million by the 80 years and then divide it by the 12, and that's your premium.
Okay.
So a whole life is fully funded at age 100.
Right.
And it has cash value basically from day one, but you may not have access to the cash value that you're paying into it. But basically you're prepaying that money into a whole life product.
Right.
A term is like it sounds, it's for a term. So you get a 30-year term. So you get $1 million term policy.
Right.
And so because there's no cash value in it, you cannot borrow against that. The premium will be lower because you're not fully funding it. The carrier's fully funding it if you die within that term.
Okay.
And I don't remember the statistics, but the term policies very rarely pay out because you usually outlive the term.
Right.
So IUL or a UL product is the best of both worlds.
Okay.
It has cash value like the whole life, but the premiums are closer to a term.
Okay.
And then you can actually set those IULs up like a secondary retirement fund if it's started soon enough.
Okay.
So you can actually build enough cash value that you're borrowing against the death benefit. So your family members will get less. So they won't get the $1 million policy because you've been borrowing against it because you're using it for your retirement. But that's the difference between those three. And so it just depends on what you want, and make sure you talk with your insurance specialist and make sure you get the right policy for you. And the younger and healthier you are, the better your rates are going to be on any life insurance policy.
Okay. Very good. So Karen, if somebody was looking at trying to decipher what would be better for my situation, you could sit down and counsel them and show them how that would look for them then.
Yes. And it's like, we'll look at their health, because what the insurance carriers are going to look at is they are going to look at the list of medications that they've been filling at their pharmacies. So, and they will look at what they call the pharmacy bureau to check to see what has been filled, how often it's been filled, and they'll use that to determine which rating table you go into. And they'll look at the age, and then obviously the amount you're wanting paid out at the end of the policy, which is at the death. And that's how they determine the rate. So that's how they determine your premium each month or each year, depending on how you have it set up.
Very good. Well, Karen knows this very well, and she could walk you through everything that you would need to know to make a good decision. So you can reach Karen. Her information's here on the screen. So we've got her office information and her direct number. So make sure to reach out to her, schedule that appointment so she can help you get that going. Karen, I appreciate your time so much.
Thank you, Heather, for having me.